I'm here today with Craig Johnson of Piper Jaffray, Mr. Technical Analysis. Craig, I think when most people hear the term technical analysis, they think of charts with squiggly lines and this goes this way and this goes that way. Probably they don't have the best understanding of what technical analysis is. So there's different genres. Why don't you tell them?
Sure. So technical analysis is really understanding emotion in the market and also supply and demand, buying pressure, selling pressure. And there's many different types of technical analysis.
Right.
The founding father of the MTA, Ralph Acampora, would always use point and figure charts. Katie Stockton will use cloud analysis and other types of technical that way. I like to use just straight up trend analysis. I'm looking for trend reversals. I'm looking for breaks above and below moving averages. I'm looking for clear changes in breaks and changes in psychology. And I'll do that by simply using trend lines. And I find that to be a very useful tool in markets that are moving out or trending in a very distinct direction. And you want to ride the trend until you see that break finally occur.
So the trend is your friend until it isn't.
Trend is your friend until it isn't is a great way to put it. A lot of people think of that as negative. But when I go back and I look at the long-term returns of sticking with your winning stocks, cutting your losing stocks, that's ultimately what we want to truly do. And simply using technical analysis and trend lines really helps keep you in these positions and helps you put definitive lines in the sand as to when you want to actually make a trade and when to change a position.
We have had trending markets. We went through an interesting period. I like to call it the QE era, which I think changed the dynamics of the market a little bit. But we've had little pockets where volatility has raised its head, and then when it's gone back to sleep. Something happened in January.
Yes.
Okay. Something changed with the psyche of the investor. From your viewpoint, what do you think that was?
Simplistically for me, what I saw back in January, and let me just kind of add in here, we lowered our recommended equity exposure to the lowest level in a decade. It's now 85%. We were 95% previously. The last time we had a recommended equity level this low or lower was back in 2007. At the beginning of the financial crisis. And the question you asked me is what has changed and what did we see back then? What we saw simplistically is this. Parabolic charts, they were basically going straight up. Now you say, why? That's great. Charts are going straight up. We should be happy about that. The problem is it's not sustainable. You started seeing many stocks in the Dow, the S&P, even the FANG stocks start trading 20 and even 30% above their 200-day moving averages. And when I've gone back in history and I've seen that typically is not a sustainable advance and a pace of that advance. So markets usually end up coming in. And let me just add real quickly, parabolic advances end one way, poorly. And they typically come back and retest about 100 to 110% of the advance. So we want to be very careful with those kind of advances.
Okay. We're with Craig Johnson at Piper Jaffray. You're listening to Mr. Technical Analysis. Thanks for being with us.